First of all, welcome to everyone that is here this afternoon or this evening, depending on where it is in the world that you're joining from. Just a bit of an introduction to who it is that is speaking today. I am Matthew Theron. I'm a senior associate with Holborn Assets, which is a global financial advisory, the second largest global financial advisory globally, actually. With me today is Jade Kramer, who is also a senior associate here at Holborn Assets. And then invited along today is one of the people that we deal with quite regularly, Thomas Lobban from Tax Consulting SA. And they are literally the people who wrote the book when it comes to expatriate taxes, literally the LexisNexis one. So over to you, Thomas, if you could just give us a brief introduction first of who you are, the sort of work that you do at Tax Consulting SA, and a little more about the company.
Absolutely. Thank you. Thank you, Matthew. And it's good to be here with everybody. I am, again, Thomas Lobban. I am legal manager for cross-border taxation at Tax Consulting South Africa. We are South Africa's largest independent tax firm, dealing with all matters related to tax, from a legal perspective, accounting, stemming all the way into immigration, payroll, and remuneration structuring, among others. We specialize in certain matters, and one deep area of focus for our firm is expatriate tax. We like to think of ourselves as one of the leading market leaders, if not the market leader in the space from the South African perspective.
Okay, so then a little bit about us in terms of Holborn and how we fit together. Obviously, Thomas and his team do with the tax side of things. We as international wealth managers, something that often we get asked about is when you're saving your money, do you save it back in South Africa? Do you send it home? And well, if not, what are the alternatives? What can you do with it? And that is what we get asked on a regular basis, and also what we specialize in. We specialize in that structuring of investments as well as asset management outside of South Africa. Now, when it comes to Holborn as such, we have what we call the 5 pillars of our business, which explain why we have grown so successfully and what makes us special and different from the others. And the first pillar is our size, the fact that we are the second largest independent financial advisory globally. We have clients in over 30 different countries. We have offices and licenses in over 13 different jurisdictions. So we truly are a global company rather than just a South African-based company advising clients outside of South Africa.
Yeah, perfect. Also, another reason why people do business with Holborn is because of our service. We, no matter where you are in the world, we will look after our clients, and we make sure that we see our clients every quarter. So whether it's just to update you on market conditions, new changes in legislation, new products in the financial world, we make sure that we touch base with our clients every quarter. And we've actually recently won 8 awards in our International Investments Award, which is kind of like the Emmys and Grammys of financial services.
The third pillar or reason why people do business with us, and I feel this is probably the most important, is the fact that we are a truly independent financial advisory. So we are not owned, nor are we incentivized by any one fund or asset manager, which means we're able to do what our clients want with great impartiality. So, if I was still working at Sanlam as I did a few years back, miraculously, whatever solution I'm going to present will be a Sanlam solution, whereas I am now no longer constrained by that.
Exactly that. And another reason, the fourth reason why people do business with Holborn is due to safety and security, which I think is quite relevant to this webinar. We are allergic to losing money, and we are allergic to institutional risk. So when it comes to diversifying our clients, we will not ever just trust one asset manager, the custodian of our clients' money. We'll look at least 8 to 10 different fund managers, and we'll only structure assets where the government backs the investments. We'll get into a bit more about that just now. I think Jersey, Guernsey, Isle of Man, Malta, Gibraltar, all places with strong links to the UK. We only structure assets where the government puts a guarantee on capital, and we take the safety and security of our clients' hard-earned money very seriously.
And then finally, the last pillar of our business, and the reason why we form associations and partner up with firms such as Tax Consulting SA, is the fact that our advisors and wealth managers are the most qualified and best educated that you will get in the world. A very far-reaching statement, but certainly a true one. And For someone not living in South Africa, for someone who is saving their money offshore, living offshore, you send your money back home to South Africa, where you get a South African financial advisor. And although he can advise you with regards to investments in South Africa, he won't have the licensing, the accreditation, the knowledge, or even the experience when it comes to your international investment platforms, what is available out there. You know, with regards to SA versus the globe, it's like fishing in a pond versus fishing in the ocean. You know, you have roughly 1,500 different investment funds inside South Africa because of regulation, whereas abroad you have access to over 55,000 different funds. So you need someone who is educated, qualified internationally, but has that unique, perspective to be able to advise South African tax residents. So with that said, what we'd like to do is we're going to hand over to Thomas first and ask him just to give us a little bit of the implications of working abroad versus working in South Africa when it comes to income, when it comes to taxes. There's very much a misconception out there, and the reason for why we're having this webinar, that if you're not inside South Africa, you don't have to pay tax inside South Africa. There are certain exemptions applicable, there are certain limits. So when are you still subject to tax in South Africa, and when are you not? And this is where we'll hand over to Thomas to talk us through that.
Thank you, Matthew. So the first concept that would need to be unpacked here, as you rightfully mentioned, is tax residency. And I'm sure we can get into this at a later stage, but if anybody here is a South African living and working in South Africa, or whom sees South Africa as their home, even if they're not here, would be a South African tax resident. And what this means is essentially that South Africa can impose tax on your worldwide income, i.e., it doesn't matter where you are when you're earning that income, where that income is earned from. Is your employer foreign? Is it paid from a foreign account? Is it paid to a foreign account? None of these questions matter. South Africa still has the right to impose tax. Now, very important and part and parcel with that is the fact that one cannot simply leave South Africa without considering the South African tax implications of the income that they are earning. And the fact that they may pay tax abroad itself doesn't mean that they don't have a liability in South Africa. To reiterate that point, it's not a case of, but I have paid tax there. You might have relief applicable to you, and I'll get into that now, but this relief must be claimed at SARS level. A person who, for example, is working abroad as an employee will have an exemption for up to 1.25 million rand on their employment income specifically, based on them spending more than 183 full days abroad, of which more than 60 are continuous within a 12-month period. In addition to this, where that person pays tax in the other country, they may further claim a credit in South Africa for their foreign taxes paid. Where you're not an employee, however, only the tax credit relief would be applicable, as again, you are a tax resident. In these cases, more specialized relief, such as financial immigration to permanently cease your South African tax residency, or the application of a double tax agreement, abbreviated to DTA, to temporarily cease your residency may be required. For other forms of income, such as non-South African, or where you cease your residency, South African retirement interests, the application of a double tax agreement may be required, albeit to be applied in different ways. So very much when you're abroad and you're working abroad, you're earning foreign income, you need to split your mind into two places. One is the implications from a tax perspective of where you are earning that income, where you're living and working. And on the other side is South Africa. It simply doesn't let you go that easily, which is why we always iterate and reiterate and emphasize time and time again that it's important for you to speak to a competent tax advisor, ideally before you leave, and certainly after you leave. This is an area of focus. It's an area of specialization, and an accountant although many may be able to deal with these issues, might not be able to deal with them in the most efficient manner.
Absolutely. That's where, you need to speak to a specialist. Now, I know that out there you will get many, for example, who will say, well, I was told that I don't have to pay any taxes. Let's take someone, for example, working on a yacht. They're assuming that, well, their local accountant told them you don't have to pay any taxes, so therefore I don't need to submit any returns. I don't need to do anything. I can just travel the world and not be responsible for anything. How true is that? If you can just shed a little bit of light on that.
Absolutely. That's a brilliant question, and it leads into another misconception. In many, many, many cases, we have clients that come in and have been advised by their accountant, for example, who has applied some exemption and told them, you don't have to file a return, or we'll file a null return for you. You have a full exemption in South Africa. In one case, you mentioned working on a yacht, for example. There's a very specific exemption that applies to somebody working on a yacht under section 10101 of the Income Tax Act. It's similar to that 1.25 million rand relief, except without a ceiling. Now, it's not sufficient for you to simply not file a tax return where the legislative requirements say you need to. And at the same time, you can't submit a null return, even though that exemption might result in no tax payable in South Africa. An accountant thinks no prejudice to the fiscus, there's no tax for SARS to claim. A SARS auditor thinks we have no idea if you've met these requirements. So submitting a null return instead of submitting the claim for that exemption in your return means that, one, SARS can discover this, and because they haven't been given the opportunity to audit, they may raise that additional tax at a later stage, or at a bare minimum, it's non-compliant. So it gives SARS a reason to place your profile in a non-compliant position, which may impact your visa application in other countries or hold you up in certain ways, otherwise withhold refunds that are later due to you, or give a SARS auditor a reason to open an audit because it is technical non-compliance. They can use that to go as far back as they like. Once SARS identifies high-level non-compliance, they're not limited in how far back in your returns they can go. So we generally do advise clients, if you do believe that you are eligible for an exemption, rather submit your tax return correctly, claim it, have SARS ask the hard questions that they need to. If you're eligible and you can show as such, there's no reason to be concerned.
What about those who've left South Africa, straight after university or college, never registered for taxes here, never paid taxes here, but now are earning an income offshore? What is the responsibility and the requirements with regards to SARS for that?
In those cases, the first question that any diligent tax advisor will ask is, and I'm sure we can work into a further discussion on tax residency, but they will ask you what your intention is, how long you're going to be spending abroad, and when you're going to be coming to South Africa, if ever. If it's apt to cease your tax residency, then that's something that should be done. If you fall into the if you fall into the requirements as somebody who needs to submit a tax return, you still have to do so. So if you're somebody who is a student, for example, you've just graduated, you go abroad, you've never had to file a return in South Africa before, it is still prudent to register for a South African tax number. SARS may not cotton onto that issue now, but if you do in future return to South Africa and find yourself needing to submit returns, SARS may identify, with reference to your ID number, the fact that there is a gap as far as life stages go from an employment income point of view. And they may look into your foreign accounts and see that you've earned income and raise difficulty at a later stage.
And that I can certainly attest to in terms of my own personal experience, having moved back to South Africa sort of 3 years ago now. I didn't see myself as ever moving back, but after the birth of my daughter, there truly is no better place to raise a child. And yes, All 3 years in a row, I've been audited, severely audited all 3 years in a row, needed to do backdating of tax returns. Literally, they audited me going back 10 years because of that gap. Again, my intention was never to return, but life happens. And as a result, I still became a South African tax resident. So, we'll carry on. We'll talk a bit more about that later. So one of the things that Jade and I would like to, bring about is when you are taxes aside, when you're saving your money, and we'll talk about this at a later point in terms of your intention. If your intention is to stay abroad and not to return to South Africa, well, then often the question gets asked, you're living out in the Middle East somewhere, or you're living out in Asia or Europe, but you send all your money home every month. Your retirement savings is at home. Your regular investments, your tax-free savings, all of that you're still somehow doing in South Africa. You go back to South Africa on a regular basis. You've perhaps bought a home or you own a property in South Africa. Are you truly then someone who doesn't plan to return to South Africa? Because if so, why wouldn't you just save your investments offshore? Why wouldn't you do retirement planning offshore? Now, a question that we get asked very often from clients, not only abroad, but also in South Africa is, well, what are the options available to someone who wants to be able to save their money abroad, who wants to be able to set up their pension outside of South Africa, who wants to set up their regular sort of savings for their surplus, for their buy property, that sort of thing? Well, the first thing that we say is one needs to look at your gut feel. And here, this is where I'll hand over to Jade if she can give us a bit of guidance on this. It's something that we like to call, your essay versus the globe. No asset manager or wealth manager can tell you you need to be saving this amount offshore or this amount in South Africa. It depends on every individual client and how they personally feel about South Africa, the future of South Africa, and themselves. Jade, if I can ask you to elaborate on that.
Sure. Yeah, so exactly that. I mean, a lot of our clients are offshore, whether it's on the oil rigs, on Emirates, whatever the case is, and they say, how much should I save offshore versus locally? I still have my South African bank account. Maybe in the next 5 to 10 years, I'm coming back. And there is absolutely no right or wrong answer for this. The best thing, as Matt just said, is your gut feel. So if we had to give you a scale, this is a very general test for yourself. If we had to give you a scale of 0 to 100, 0 being Zimbabwe, hyperinflation, unemployment's through the roof. We've seen what's happened there. Or on the other end of the spectrum, a great country like Singapore, where everything works, where, there's very low unemployment. Where do you see South Africa going? Do you see it going towards the Zimbabwe route in the next 5 to 10 years? Or do you see things turning around here in a big way that will affect your investments here? Because obviously with regards to South Africa, all of those things, taken into account will affect the rand depreciation. So that is obviously a big discussion we have with our clients. If you were to live off dollars, pounds, Swiss francs, euros, and you still in South Africa, or even if you stay abroad, at least your value of your money is held a lot harder than it would be if you were to be converting into rands. So let's say your gut feel is a 3 out of, or 30 out of 100. 70% of your money then should be offshore, 30% should be here, and vice versa. So completely, it's on a case-by-case basis, but we will say that if you're living in South Africa and the rand does continue to depreciate, you're probably in one of the best situations in the world, especially if you've structured it, correctly, as we'll get to a little bit later. But if you can also earn in a hard currency and invest in the best funds in the world, I think you're in one of the best situations.
Yeah, I think it's effectively just hedging yourself against your own sort of gut. And that is effectively what we advise many clients to do. Something that Jade mentioned is, the fact that you're able to invest directly in a primary currency, something like pounds or euros, Swiss francs, dollars, for example. Something that I found most people find extremely fascinating and aren't even aware of, even people in the financial services industry. If you were to go back, say 30, 40 years, look at the rand versus the dollar, for example. Now, assuming whatever savings and investments you're doing, you want that money to last you a good, decent time. So, let's look back at the history of the rand. Now, if I were to ask, and it'd be helpful for most of you on today to just give a wild guess. If you had to guess over since, say, 1980 or 81 to now 2020, 2021, how much do you think the rand has actually lost in terms of value against the dollar. What sort of percentage? Just a wild, rough sort of guess. I'll give you a second just to think about that. And now I'll tell you to try and think of a much bigger number, because most people that I have spoken to will guess 40, 50%. Some will say 60. You'll get a few will even say 300%. And what I tell them is that you need to remember that in 1980, the rand was roughly 80 cents to the dollar, which means the rand was at a stronger position than the dollar was. And now recently, yes, we're not at the days of 19 like it was a few months back, but we are at 16 again. So whatever number you've chosen, you need to make that a lot larger. In actual fact, depending on which dates you take it, because you can fiddle these numbers around to suit yourself. But you're looking at roughly between 1,700 and 2,200%. And this is the thing, if I was sitting with you now, we're sitting in Cyprus somewhere at a cafe or in Seoul at a Starbucks, and I'm telling you, look, Tom, or Sarah, I'd like to set up an investment for you, and over the next 30 to 40 years, it's only going to lose 1.5 to 2,000%. Would you invest in that? But yet that is exactly what you are doing when you send your money back into a rand-based investment locally in South Africa. So that's quite a fascinating fact, and that's something that we'll go through again in more detail individually if you like. But let's bring things back now to so you want to be able to save your money, you want to be able to do it offshore. Yes, there are certain advantages in that you can save in tax-free jurisdictions. You get access to global markets, to more funds that are possibly available in South Africa. You get access to things such as Vanguard, BlackRock, funds which are not available inside South Africa. So that apart, if we look at it, for those who are sending their money back home, there's also quite a bit of misconception there of what you can and cannot do. Thomas, perhaps you can give a little bit of feedback on this. I know of quite a lot of people who will send their regular savings home to South Africa and they'll put it into a tax-free savings account. Do you need to have a tax number in South Africa to be able to benefit from a tax-free savings account?
Well, Matthew, it depends on who you ask. You'll find that from a SARS perspective, anyone can invest in a tax-free savings account. It's not restricted. Even a child could invest in one or more tax-free savings accounts. What matters is the fact that it's tax-free, but only insofar as you meet the requirements. And again, it's a painful term in tax, and I'm sure in law in general, it's always about meeting the requirements. A tax-free savings account, you have 33 or 36,000 Rand per year that you can invest tax-free, but also up to 500,000 Rand for a lifetime. Now, the moment you exceed any of these limits, you'll find very quickly that you are required to register for tax and pay the balance in South Africa. You fall outside of those relief provisions. Again, you don't technically need a tax number when investing into a tax-free savings account, but the providers of tax-free savings account, when doing their Know Your Customer KYC processes, will require, one of their requirements will be that you do provide a tax number so that they can issue a certificate at the end of the tax year that reflects whether you do or you don't pay tax on the growth of those investments. So the technical answer is no. The accurate, practical answer is yes, you absolutely do.
And just quickly, because many people aren't aware of that, the limit. They may be aware of the 36,000 a year, but the 500,000 lifetime limit at the moment, that's roughly what, about $30,000, which is not a huge amount of money. What happens once you've reached that limit and you want to be able to save more money into that?
Anything you're permitted to save more money into it, but any further contributions that you make will be subject to tax. So there will be proportional tax on the proportional growth of your portfolio beyond that. Really, this is not intended to be a form of relief from a parliamentary or a legislative perspective that one can take into massive growth areas. But once you do hit that maximum contribution limit, if you do not want to be paying tax on the growth of those assets, then you need to work with what you've invested. As a general rule of thumb, although I am not an investment advisor, I am only a tax advisor. For tax purposes, it is prudent to understand that it's not a good idea necessarily to withdraw from those funds. What you put in should stay in a tax-free investment.
Exactly, yes. Jade, you have many clients that deal with retirement annuities. Jade also has a lot of her local licenses and clients inside South Africa. Any questions on the retirement annuity side of things, Jade?
Yes, yeah, Thomas, with regards to local retirement annuities, I mean, this is something that we actually get asked quite often, especially with clients offshore. If you aren't claiming the rebates for them now, and you don't ever return to South Africa, how will you be able to benefit from these tax deductions? Will you be able to? This is quite a gray area. So what is your opinion on this?
Appreciate that. And I'll do my best to give as accurate an answer as possible here. Now, when it comes to retirement interests in South Africa, what you invest into a South African retirement vehicle, you are entitled to a deduction of a maximum of 27.5% up to a ceiling of 350,000 Rand a year. Can come off as a deduction from your your income in South Africa. However, in order to claim this deduction, you need to apply for it in your tax return in the same tax year. So when you file your tax return for the year, those contributions need to have been made in that relevant tax year, and you need to claim it in the return. What you cannot claim in that tax year, what goes over the 27.5% up to a maximum of 350K, or otherwise, if your taxable income was too low, will flow over to the next tax year and the next tax year and the next tax year. However, if you don't make those contributions in the relevant tax year and claim that relief in the tax return, that will fall away and you'll lose the benefit of that deduction later on. So if you are somebody who wants to invest in a retirement vehicle in South Africa for purposes of claiming that deduction, it's important to follow due process and do what you need to when you need to do that.
Okay, perfect. And then just still on the RA question, what is your opinion on the proposed exit taxes on retirement annuities?
That is actually a very, very relevant question. So to add a little bit of context for the audience, the National Treasury had proposed that those who cease their South African tax residency would be deemed to have withdrawn their retirement fund interest, even though they may not have actually withdrawn anything, for the tax to then be withheld at the later point that they actually in reality do withdraw. SARS would withhold that, or the policy provider would withhold it. Now, there were numerous issues that cropped up. The reason for the proposed amendment, the proposed withdrawal and exit tax or form of exit tax on that, was because in South Africa's view, they were losing their taxing right over that retirement money after these individuals had ceased their residency, where a DTA allocated the sole taxing right to the other country. On the other side of the coin, however, many advisors, and not the least of which Tax Consulting South Africa, had raised the point that this would inevitably lead to double taxation, where South Africa was effectively introducing a treaty override and thus flouting its obligations in terms of DTAs. We were in front of Parliament a few weeks ago, motivating for the withdrawal of this proposed amendment, and which was successful. So Parliament has now withdrawn the proposed amendment, and that is no longer something that will be put in place.
That's certainly good news for most.
For now.
Yeah, but the fact that they're talking about that isn't, it doesn't give us much peace of mind.
Well, the view of Tax Consulting in this specific regard, from what we've seen in practice, is that National Treasury is very much focused on two areas specifically here. One is expatriate tax compliance, but also essentially squeezing the sponge. They're looking at retirement interests as well, very sharply. So this is not something that's going away. This is not something that will see the heat turned down on anytime soon. And we can only hope that it gets better.
And this is why efficient and proper structuring of your savings or retirement planning or investments offshore is key. There are a lot of South Africans out there who are under the misconception that, you have your money in an Isle of Man account or somewhere abroad, and it's therefore out of the jurisdiction of South Africa. But what is often overlooked or not seen is the fact that your Isle of Man account is wholly owned by a South African bank or by a South African company, which then brings it still under the jurisdiction of South Africa and gives SARS as well as the government reach when it comes to forced repatriation. Not only that, but something that's also often overlooked is common reporting standards, or CRS. The fact that banks do now share that sort of information, and with the new international exchange of information program that's out there, yes, SARS might not know about you now, but they will in future. And the thing is, and this is what I always tell my clients, would you rather have a difficult conversation with myself now, or have that difficult conversation sitting across from three people at SARS? You need to structure things correctly. You need to set things up well now. And again, there to it, structuring and setting things up is important because, as you mentioned earlier, when it comes to the physical presence test, but also there's the whole intention. Now, the way that I understand it, when it comes to SARS, you may be outside of the country for the qualifying amount of time. Someone who's not here, you may not even have been here for the last 2-3 years. But all your savings are here, all your retirement planning is here, your family is here, you come back here on a regular basis. And there, in terms of a balance of probabilities, what does that mean in terms of tax residency?
That is exactly the question I was hoping you would ask. So tax residency in South Africa is based on one of two things. First and foremost, what is looked at is whether you are ordinarily resident in South Africa, which is a special little term that speaks to your intention. Do you see South Africa as your permanent home? If you do not already live here permanently, is South Africa the place to which you will ultimately return from your wanderings abroad? Ask yourself, will I retire there? If this is the case, determined on a balance of probabilities, is it more likely that it is South Africa that is your permanent home than not, then you would be seen as ordinarily resident, therefore resident in South Africa. Now, remember in all of this that the onus of proof lies on the taxpayer, not on SARS. If you are alleging that you are not a tax resident, you need to be able to prove it. Now, if at no point during the tax year you're ordinarily resident, you may still be captured by South African tax residency by virtue of your physical presence. And it's a little bit of a difficult test to grasp when it's first told to you. But if you're somebody who has spent more than 91 days, partial days, in South Africa during this tax year, as well as more than 91 days in South Africa in total in each of the 5 previous tax years, and more than 915 days overall in those 5 previous tax years, then your physical presence in South Africa during that time will render you South African tax resident. Now, on the other side of the coin, if you are ceasing your South African tax residency, this is also a declaration that needs to be made to SARS, and you need to be able to prove that you will meet the requirements to no longer at least be ordinarily resident, again, on a balance of probabilities. And if you cannot do so, if you cannot pass muster in that regard, unfortunately, you'll remain tax resident because the balance of probabilities is no longer in your favor.
Exactly. And something else that also needs to be taken into consideration is particularly with expats who live in countries where there is no future hope of becoming a citizen within that country or gaining permanent residency. That same intention and balance of probabilities, well, you're probably not going to retire there if your residency is based on a visa. And when that visa is linked to your employment, if that ends and you're forced to come back to South Africa, then you cannot really argue that you plan to retire, abroad one day. It doesn't help if you've been saving your retirement savings here as well alongside that. Jade, you had a question earlier. I know we were talking about this before, and when it comes to requirements for submitting tax returns, and what is that tax consulting South Africa can help in terms of that?
Yes, Thomas, you'll know the answer to this question, but as Matt just said, when living abroad and submitting tax returns to South Africa, can you tell us a bit more about deregistering or submitting a nil return? How does that work as a South African tax resident?
Absolutely. So if you are a South African tax resident, you can only deregister for South African tax if you're no longer going to be earning a cent in South Africa or abroad. So if you're done with your income earning days, including living annuities, then maybe you can deregister, but the requirements are quite strict from a SARS perspective, and in practice even stricter. Submitting a null return largely follows the same rationale. You should not be submitting any null returns unless you're earning null income from all sides. If you're somebody's spouse and your spouse maintains you, that's a different story. But in all cases, if you're earning foreign income as a South African tax resident, automatically you'll be required to submit a tax return in South Africa. If you're going to be earning foreign income and taking into account all exemptions, tax credits, and deductions that are applicable, you'll still have a tax liability that you foresee. You may have even more tax return concerns, such as provisional tax returns, because now you're not earning income on which tax is withheld from you. So this is why, alongside a diligent investment advisor who at least has their finger on the pulse of the tax requirements that follow you as an individual, it's also important to know that you are directly advised from a tax perspective as well. In all cases, tax does not lead an investment or a relocation decision. It shouldn't. That's very, very unsustainable. And we've seen it happen time and time again. But the tax at the same time should not be a cause to avoid proper investment or a decision to relocate abroad. It is always manageable, but you cannot simply stick your head in the sand by thinking I'll deregister, or I'm paying tax somewhere, so I won't pay it in South Africa, or file a return, or I'll submit a null return. If there's an exemption to be claimed, claim that exemption. Same with deductions or rebates. It's very rare when a person does not need to file a return, but they are an internationally mobile individual.
Yes. So I'd like to not, we've been going for 40 minutes. I'd like to try and wrap things up now. Otherwise it can get a bit long. Thomas, I'm assuming that anyone interested can reach out to you directly. We will be sharing the link to this recording, and which will be emailed to all the participants automatically. And what we will do then is we will reach out to make sure that everyone has Thomas's information or contact info, and then as well as Jade's and myself's. And Thomas, we'd like to thank you for being here and for taking part, and for your insights and your valuable, the valuable information you've been able to share with everyone today. Jade, anything from your side?
No, I'd also thank you so much, Thomas. I think that it's very valuable, but like as Matt said, it's a case-by-case basis. This is obviously very general advice. And, I think everyone needs to look at their situation individually before, making any decisions.
It's been an absolute pleasure. Thank you, everyone.
Okay, we will reach out to everyone afterwards, whether it be for help on the tax side of things, or on the offshore structuring side of things and setting up your investments and your pensions and things directly abroad. But thank you, everyone, for joining, and we look forward to seeing you in some of our future webinars. Same as with you, Thomas. We look forward to working together again.
Thank you. Thanks, Matt. Right. Thanks, Thomas. Thank you, everyone.
Thank you, everyone. Okay, bye-bye.